Can you actually save $1 million on a $50,000 salary? Let's be honest, for most of us, that sounds like a total fantasy. It's a number you see in clickbait headlines, not something you expect to see in your own bank account. You read the articles, you hear the advice, but then you look at your paycheck, you glance at your rent, your grocery bill, and the math just doesn't feel real. It feels impossible. But what if it wasn't? What if there was a clear, mathematical roadmap that could turn a pretty average salary into $1 million nest egg? We were skeptical too, so we decided to run the actual numbers. We figured out the timelines and laid out the exact steps you'd need to take. In this video, I'm going to give you the straight-up mathematical breakdown, and I think the answer is going to surprise you. The secret to this whole thing isn't some shady get-rich-quick scheme or a lottery ticket. It's something way simpler and a lot more powerful: time. The single biggest factor that decides if you can hit $1 million on an average salary is when you start. Let's break down the hard numbers. To do this, we have to make an assumption about how your money grows. Just stuffing cash into a savings account won't get you there. Inflation will slowly eat away at your purchasing power. You have to invest. Historically, over long periods, the US stock market has delivered average annual returns somewhere in the 7% to 10% range. Now, that's not a guarantee. Past performance is no crystal ball for the future, but it's a realistic benchmark for long-term planning. We'll use a conservative 7% for our math to be safe, but I'll also show you how a higher return could seriously supercharge your results. Let's imagine 3 different people, all earning $50,000 a year, but they start investing at different ages. This is the golden window. If you start investing at 25 and want to hit $1 million by a normal retirement age of 65, you've got a full 40 years for your money to do its thing. Assuming a 7% average annual return, you would need to invest about $370 per month. That's roughly $4,440 a year, or just under 9% of your gross income. This is that classic advice you always hear: save 10 to 15% for retirement, and the math shows why. It's a challenge, for sure, but for a lot of people, it's doable. You're on track for $1 million by being consistent, not by living on bread and water. But what if the market performs closer to its historical average of 10%? That same $370 a month wouldn't just get you to $1 million. It would grow to nearly $2 million. That is the incredible power of compound interest working over 4 decades. Waiting a decade makes a massive difference. If you don't get serious until you're 35, you now have only 30 years until age 65. That lost decade of compounding means you have to pull more of the weight yourself. To reach $1 million by 65, you now need to invest about $835 per month. That's over $10,000 a year, or 20% of your gross income. It's still possible, but it demands a much higher level of financial focus. Saving a fifth of your income is a serious commitment. It goes from being a background habit to a central part of your budget. And you'll have to start making some very conscious trade-offs. This is where the math gets brutal. Starting at 45, you only have 20 years to reach your goal. The compounding engine just doesn't have enough runway. To hit that $1 million mark, you'd have to save a staggering $1,920 per month. That's over $23,000 a year, almost 46% of your entire gross salary. For most people earning $50,000, saving at that rate is practically impossible without a second job or a massive pay increase. The lifestyle sacrifices would be extreme. The message from these numbers couldn't be clearer. Your greatest financial asset isn't how much you earn, it's how much time you have. The earlier you start, the less you have to save, and the easier the journey. Okay, so you know the numbers. But where do you actually put that money to make it work? Here's a simple 4-step plan in order of importance. If your job offers a 401k with a matching contribution, this is the best deal in finance, period. An employer match is a guaranteed, instant return on your investment. If your company matches 100% of your contributions up to, say, 4% of your salary, that's a 100% return. You won't find that anywhere else. Before you even think about another investment, you need to contribute enough to your 401k to get that full match. Not doing it is literally saying no thanks to free money. Once you've grabbed your full 401k match, the next place for your money is a Roth IRA. This is a retirement account you fund with money you've already paid taxes on. This is huge because on a $50,000 salary, assuming you're a single filer in the US, you're likely in a lower tax bracket now than you will be in retirement. The genius of the Roth is that you pay the taxes today, while your rate is low, and in return, all of your investment growth and qualified withdrawals in retirement are completely tax-free. For 2025, the contribution limit is $7,000 for individuals under 50, and this limit tends to increase over time. $1 million in a traditional 401k will be taxed as you withdraw it, which could cost you a significant amount depending on future tax laws. But $1 million in a Roth IRA is all yours. If you're finding this breakdown helpful, and you're starting to see how the math can actually work, do me a favor and hit that subscribe button. We put out videos just like this to make money simple and give you clear advice that you can actually use. So, what should you actually buy inside your 401k and Roth IRA? For most of us, the answer should be simple and, honestly, a little boring, low-cost, broad market index funds. Think of funds like VTI, which tracks the entire US stock market, or VU, which follows the S&P 500. These funds give you a tiny piece of ownership in thousands of companies across the economy. They're incredibly diversified, which lowers your risk, and they have super low fees, so more of your money stays working for you. Trying to pick the next hot stock is a gambler's game. The simple, proven strategy is to buy the whole market and let it grow. Many experts also suggest adding an international stock fund to diversify beyond just the US economy. If you're disciplined enough to max out your Roth IRA each year and still have money to invest, you circle back to your 401k. You can contribute up to the annual maximum, which for 2025 is $23,500. This lets you keep saving in a tax-advantaged account and speeds up your journey to that $1 million goal. The numbers work on paper, but making them happen in real life means changing how you think about money. This is the final and most important piece of the puzzle. It's about building a lifestyle that makes saving automatic. Before you get aggressive with investing, you need a safety net. This is 3 to 6 months of essential living expenses parked in a high-yield savings account. This fund is your financial firewall. It's what keeps you from having to sell your investments at a bad time just because your car broke down. Your ability to build wealth isn't about what you earn, it's about the gap between what you earn and what you spend. On a $50,000 salary, your main focus has to be on making that gap wider. This isn't about feeling deprived, it's about spending consciously. It's choosing to have a roommate instead of a solo apartment. It's buying a reliable used car instead of having a monthly payment. It's learning to cook and packing a lunch a few more times a week. Every dollar you don't spend on a short-term want is a dollar you can invest for long-term freedom. One of the biggest enemies of building wealth is lifestyle creep, that habit we all have of spending more as we earn more. To fight this, make a simple rule for yourself. Every time you get a raise or a bonus, automatically split it. Half can go toward upgrading your lifestyle. You earned it, but the other half goes straight into your investments. This isn't an ironclad law, but it's a great guideline that ensures your savings rate grows right along with your income. Your willpower is a limited resource, so don't rely on it. The secret to being consistent is to take yourself out of the equation. Set up automatic transfers from your checking account to your investment accounts the day after you get paid. When the money moves before you even see it, investing just happens. It becomes your default, month after month, year after year. That is how you build a fortune. So, can you really save $1 million on a $50,000 salary? The answer is a definite yes, but with one huge condition. You have to start early and be incredibly consistent. The math isn't a fantasy. By saving 10 to 20% of your income, investing it in simple, low-cost index funds, and using powerful accounts like a 401k and a Roth IRA, the path is right there. It does require a trade-off. You're giving up some spending on short-term wants for the ultimate prize of long-term financial freedom. You trade a newer car and more dinners out for the option to stop working years, or even decades, sooner. The biggest risk you face isn't a stock market crash. It's the risk of waiting. Every year you put it off, the mountain gets steeper. You don't need to be rich to become a millionaire. You just need to be disciplined. You need to be patient, and you need to start today. The math works, but only if you do. Now that you have a plan to get to your first million, what about the plan to live off that money once you get there? It's a historical guideline called the 4% rule, but it comes with its own set of important rules and risks. I break down exactly how it works in this video right here. Click it, and I'll see you over there.